Welcome back to Skytech-Lens. Let's talk about gold, the metal that's usually just bling, but in August 2025, it became the center of a global economic storm. The Trump administration shocked the world by slapping a 39% tariff on Swiss gold bars, the very bars that underpin the COMEX exchange. Markets went wild. Gold futures soared to a record $3,534 per ounce, sending shockwaves through Wall Street and beyond. This wasn't a minor tweak. It was a direct hit to the world's main supply of investment-grade gold. The message from Washington, Switzerland: we have a trade problem, and your gold is now leverage. The groundwork was laid months earlier, but most assumed gold would be exempt, until US Customs put it squarely in the crosshairs. Chaos erupted. Then, just as suddenly, President Trump reversed course on social media, scrapping the tariff. Gold prices tumbled, but the threat lingered. The world had seen how easily the ultimate safe haven asset could be weaponized. The dispute wasn't resolved, just paused. The global financial system had been given a terrifying preview of what happens when gold becomes a bargaining chip. The golden standoff had begun. The world was left holding its breath. The stakes had never been higher. Why does a US tariff on Swiss gold send shockwaves worldwide? Because Switzerland isn't just another player, it's the gold refining powerhouse. 70% of the world's raw bullion passes through Swiss refineries, which set the global standard for purity and trust. Their bars are the gold industry's gold standard, literally approved by the LBMA and accepted by central banks everywhere, including the US Federal Reserve. When the US targets Swiss gold, it's not just taxing a luxury, it's threatening the foundation of its own financial security. In early 2025, Switzerland exported over $36 billion in gold bullion to the US, more than two-thirds of its trade surplus. No other country can match Switzerland's scale or reputation. Canada and Australia can't fill the gap, and Japan's gold stays at home. Switzerland's near monopoly on trusted gold links mines in Africa and South America to vaults in New York and London. By targeting Swiss gold, the US wasn't just picking a fight. It was shaking the keystone of the global gold market. The world's trust in gold is, in many ways, trust in Switzerland, and that trust just got tested. What was the US really after? Officially, it was about the $48 billion trade deficit with Switzerland, much of it driven by gold. The tariff was a blunt tool: make Swiss gold expensive, force negotiations, and push for a more balanced trade. But there was more. Washington wanted Switzerland to reveal the origins of its gold, pressured by US mining interests eager to boost domestic gold. This clashed with Switzerland's tradition of discretion and privacy. The gold tariff also hinted at a broader push. If Switzerland wanted smooth trade, it might need to cooperate more on financial transparency. Swiss President Karen Keller-Sutter rushed to Washington, but the US held firm, betting the shock would force Swiss concessions. It was a high-stakes gamble: deficits, transparency, and sovereignty all on the line. The confrontation was about much more than shiny metal. Switzerland didn't just accept the blow, instead it played its own hand, reminding the US that its economic power goes far beyond gold. The Swiss linked the gold dispute to other critical exports: pharmaceuticals, precision instruments, and luxury watches, hinting that trade in these sectors could get complicated. The message: hurt our gold, and you risk your access to our medicines and technology. But on banking secrecy, Switzerland drew a hard line: no compromise, no matter the pressure. The Swiss offered flexibility on trade, but not on their core principles. The US now faced a broader, more complex negotiation. Switzerland showed it was pragmatic, not stubborn, willing to deal but only on its own terms. The standoff was now about much more than gold. The gold tariff's immediate impact was chaos in the futures market, but the deeper risks were systemic. Gold underpins the global economy's safety net. Its price stability is tied to the US dollar, government bonds, and the Fed's credibility. By inflating gold's cost, the US was undermining its own financial foundation. Even a small premium on gold could push US bond yields higher, making government borrowing more expensive and potentially worsening the trade deficit. Market volatility threatened the repo market, the plumbing of global finance, forcing the Fed to consider massive emergency interventions. The Swiss franc strengthened, complicating trade further. Domestically, the Utah mining lobby cheered. But US jewelers and manufacturers faced soaring costs and lobbied for exemptions. The tariff created winners and losers, but mostly confusion and instability. The policy's blunt force exposed the fragility of using trade weapons in a complex global system. The gold market's turmoil was a warning. Weaponizing safe haven assets can backfire. The world's financial system had been rattled to its core. The fallout was just beginning. The stakes were now global. The gold tariff didn't just shake markets, it split the US political landscape. Trade hawks and mining interests pushed for the tariff, seeing it as a way to protect American jobs and force Swiss transparency. Free market advocates, Wall Street and import-dependent industries warned it would destabilize markets and hurt the economy. US jewelers and financiers joined forces, arguing the tariff was reckless and damaging. Meanwhile, in Switzerland, the move united the country in opposition. Left, right, and center all condemned the US action. Swiss negotiators gained a strong mandate representing a unified national will. The contrast was stark, a divided America versus a resolute Switzerland. The US had economic power but political fractures. Switzerland had vulnerability but unity. This asymmetry gave the Swiss unexpected leverage. The political battle was as fierce as the economic one. With both sides entrenched, a prolonged standoff loomed, bad for everyone. The US risked higher borrowing costs and a shaky dollar. Switzerland faced a devastated refining industry and soured trade ties. A compromise emerged. The US would lower or drop the tariff if Switzerland offered limited transparency on gold origins, without touching banking secrecy. Both sides could claim a win, but neither would be fully satisfied. New compliance costs would add a small, permanent premium to gold. The US trade deficit would shrink only slightly, leaving core issues unresolved. The real divide was deeper American demands for openness versus Swiss insistence on privacy. The deal would be imperfect but better than a trade war. The art was in selling compromise as victory. The world watched, hoping pragmatism would prevail. As the dust settled, both nations faced tough choices. The US could accept a compromise, restore stability and risk looking weak, or double down, reimpose tariffs and trigger more chaos. A third option, try to build up gold refining elsewhere. A costly, years-long gamble with no guarantee of success. Switzerland could accept limited transparency, protecting its industry but conceding to US pressure, or refuse, risking economic pain but defending its principles. Both sides were playing chicken, with billions and reputations on the line. The global gold market hung in the balance. Every move carried risk, financial, political, and diplomatic. The next step would shape not just US-Swiss relations, but the future of global trade. The world's eyes were fixed on Washington and Bern. The golden standoff was far from over. The US-Swiss gold dispute was a wake-up call for the global economy. One targeted tariff exposed just how fragile and interconnected the system really is. The clash was about more than gold. It was a battle of worldviews, American power versus Swiss discretion. The choices ahead are stark compromise and stability, or escalation and chaos. A deal would show that even in an era of economic nationalism, pragmatism can win, but scars and mistrust would remain. Escalation could trigger a new era of tit-for-tat trade wars, harming growth and cooperation worldwide. The golden standoff is a microcosm of the world's biggest questions: shared rules, or zero-sum power plays. In the end, even the winner risks a Pyrrhic victory. Thanks for watching a video and subscribe to the channel now, for more updates. Thanks.